Hello everyone. So welcome back to another revision lecture. This time we'll be covering two standards, two very much related standards, which is AS-10 and AS-26. So first let's get started with AS-10. As usual, we will revise certain concepts and then we will see certain interesting questions both from your textbook as well as from ICA past questions. Let's get started, and you all know PPE is an asset which is mainly held for use. So it is not held for sale. Something which is held for sale will be called as inventory. It will be covered by AS2. So PPE is nothing but a tangible asset that is held for use in the business. It can be either used for production of goods or for rendering services, or you can give it on rental to others, or you can use it for administrative purpose. Any purpose for which you use it in the business, it is called as PPE. Remember, not only those which are used for production purposes, even those tangible assets which are used for administrative purposes, those are also called as property, plant and equipment, and they get covered under AS-10. Here the most important thing is these assets should be held for use, not for sale, and their life should be more than 12 months. So minimum should be more than 12 months. Only then it will be covered under this standard. So this is very, very important to understand this definition. Okay, and then AS-10 says initially when you want to pass a journal entry, to recognize a property, plant and equipment, a property, plant and equipment should be initially recognized at cost. Please remember this, it should be initially recognized at cost. Initial recognition liye fair value or revaluation model is not allowed. AS-10 is very, very clear. Initial recognition is only cost model. Sir, what do you mean by cost? Just remember like this, we would have discussed this several times in the class. Cost means whatever you have sacrificed. Cost is the total sacrifice that you have made to get an asset. If you have given cash, whatever cash you have given. If you have given some other asset, whatever is the market value of that asset which you have given is the cost of the asset which you have acquired. So keep this very strong in your mind. Cost means whatever you have sacrificed. And AS-10 gives us more guidance on what is cost. AS-10 says cost includes three things. One is purchase price. Basically, whatever is the price of that PPE, in this we will add non-refundable taxes. Like how we learnt in AS2, same way taxes without ITC will be added, and if there is any trade discount, those trade discounts will be subtracted. This is how we will calculate the purchase price of PPE. We will take the original price, we will add non-refundable taxes, that is taxes where there is no input tax credit, and then we will subtract the trade discounts, and then we will add any other directly attributable costs. Remember this, directly attributable costs are those costs which are necessary to bring the asset in the location and condition and in the manner that is intended by the management. Management ki endha location la venumo, management ki endha condition la venumo, till the asset is ready for use, whatever cost that you are incurring because of that asset, all those will come under directly attributable costs. Sir, are there any examples for this? There are a lot of examples. For example, transportation cost. If you are buying it from somewhere else, you have to transport that particular PPE to your location. Those transportation costs. Transit insurance. During the transportation time, you have to take insurance, right? The transit insurance cost. Then to install the machinery, you have to prepare the site. Site preparation cost. Then you have to pay some professional fees for installation. That professional fees also can be taken here. And also remember, any cost that is incurred for trial run, any cost that is incurred for trial run is also a directly attributable cost. But only thing is that in case of trial run, whatever cost you incur for the trial run minus whatever money you receive by selling the products that were produced as a part of trial run, that net cost. Now, for example, assume during trial run you are producing 100 units of a product. That product you will be able to sell, you will get some sale value. So to sell this 100 units of, to produce this 100 units of a product, whatever cost you have incurred, subtract that from whatever sale value you have got. The net cost alone will be capitalized to the plant and machinery. So like this site preparation, professional fees, installation charges, like this trial run cost, all these are directly attributable. So basically remember like this, till the time PPE is ready for use, whatever cost you incur, those costs should be capitalized. And then finally there is one more thing called as decommissioning restoration liabilities. This is basically, sometimes in the agreement it will be written that this asset, because of using this asset, there will be some issues happening. For example, assume that you have purchased a land from government on which you are constructing a nuclear power plant. And what the government says is, this nuclear power plant maximum you can use for 40 years. After that 40 years, you have to dismantle this power plant. You have to restore the land in the same way it was when it was given to you. Okay, so this nuclear power plant should be dismantled after 40 years. You should restore the site, you should restore the land and give it back to the government in the same way it was. Now see, for this nuclear power plant, whatever construction cost, that will be added to that nuclear power plant. Plus, what AS-10 says is, after 40 years, you have an obligation to spend some money on this restoration. That cost you have to incur. After 40 years, whatever cost you are going to incur, AS-10 is telling, estimate that cost now itself. Estimate that cost now itself, and you have to discount that cost and calculate the present value, because this is future value. 40 years kapura you are going to incur. So whatever you are estimating, that is future value, discount that future value, bring it to present value. This present value of that cost only will get added to the nuclear power plant. The journal entry will be nuclear power plant account debit to provision for decommissioning, Now vechiko, whatever cost that you're going to incur in the future at the end of the life to restore this asset back, that cost should be estimated, that cost should be discounted. The present value of that cost will be added to the value of the asset and it will be kept as a provision. So the journal entry will be nuclear power plant account debit to provision for decommissioning. And whatever gets added to nuclear power plant, that will get depreciated. Then whatever is there in the provision, see, you converted this future value to present value, correct? When you are converting from future value to present value, you are removing interest. Now every year you have to again bring that interest back. Every year you have to keep accruing interest. The journal entry will be interest account debit to provision. As you accrue interest every year, after 40 years, it will come back to this future value. You will have a provision equal to that future value. That amount will be paid to restore this asset, Able to understand? Okay, so first, estimate whatever cost you are going to incur in the future at the end of the useful life. Present value that cost, that present value will be included in the cost of the asset also. A provision also will be created. Whatever is included in the cost of the asset will be depreciated. Whatever is there as provision, that provision every year we will keep accruing interest by passing the journal entry, interest account debit to provision account, and then finally we will get back the future value which will be paid at the end of 40 years. So if you add all this only, you will get cost of an asset. These are only included in cost. Sir, now what are excluded in cost of PPE? Then AS-10 says, any cost incurred for opening that facility. For example, you are constructed a factory and now you are going to open that, you are conducting a big inauguration function. All that inauguration function cost cannot be added to cost, it should be charged to P&L. Same way, any cost of advertising and promotional activities also should be charged to P&L, it cannot be capitalized. And any training cost, now you assume you have purchased a new PPE, new plant and machinery, you have to train your staff to make them use that PPE, the training cost should be taken to P&L, that should not be added to PPE. And similarly, any other administrative and general overheads also cannot be added to PPE, it should be charged to P&L. Remember, inauguration cost, general and administrative overheads, staff training cost, advertising cost, all these cannot be added to PPE, it should be taken to P&L, it should be taken to P&L. Hope you are very clear with this. So now initial recognition is always at cost model, and we have discussed what is the definition of cost. When you think about cost itself, your mind should say cost is equal to sacrifice. That is the inherent definition of cost. All these are examples what all can be included in the definition of cost. This is how you have to initially recognize an asset. Okay, sir, I have initially recognized now. Subsequently, as at the balance sheet date, what should I do, sir? Subsequently, as at the balance sheet date, now we all know initial recognition is always at cost. But subsequently, as at the balance sheet date, AS-10 gives us an option. It says either follow cost model or follow revaluation model. This is an accounting policy choice, your wish. Sir, appadina for every asset I can choose as, sir, for plant and machinery 1 cost model, for plant and machinery 2 revaluation model. No. This choice of the model, whether it is cost model or revaluation model, it should be based on class of assets. That means, for class of assets means a group of assets which have same nature and same use, or in other words, group of assets having similar nature and similar use. Only for these assets we have to choose a model. For example, assume you have 10 plant and machineries and you have 5 buildings. Now this 10 plant and machineries will be one class, this 5 buildings will be another class. Now for this plant and machinery you can choose one model, be it cost or revaluation. For these buildings you can choose one model. But whatever model you choose for buildings should be applied for all the 5 buildings. Whatever model you choose for plant and machinery should be applied for all the plant and machineries. Okay, so this is how AS-10 says you should choose cost model or revaluation model based on class of assets, based on class of assets. Okay, now when you follow cost model, sir, at what value we should show in the balance sheet? Very simple. Original or cost we would have debited, then subtract whatever is the depreciation charged, cost minus accumulated depreciation. If there is any impairment as per AS-28, that also should be subtracted. So if you follow cost model, carrying amount in the balance sheet will be original cost minus accumulated depreciation minus accumulated impairment loss. The net amount will be the amount that will be shown in the balance sheet. Same way when you are following revaluation model, remember, as at every balance sheet date, the asset should be shown at fair value. The asset should be shown at fair value. Remember, when you are following revaluation model, as at every balance sheet date, what value comes in the balance sheet should be fair value. Sir, now how to account this? Remember, for example, assume you are purchasing an asset for 10 crores. Okay. As at the balance sheet date, fair value of that asset is 15 crores. Now revaluation profit or loss? Obviously revaluation profit, because the value of your asset has increased. So we have 5 crores revaluation profit. AS-10 says this revaluation profit should be taken to revaluation reserve. Remember, if there is any revaluation profit, that should be taken to revaluation reserve. Okay, sir. This year I will show in my balance sheet at 15 crores. Again, next year I am going and comparing with fair value. Now the fair value has reduced to 7 crores. Fair value has reduced to how much? Fair value has reduced to 7 crores. The value of your asset has gone down. Appa profit or loss? Loss. How much is the loss? 8 crores loss. Sir, now what to do with this 8 crores loss, sir? AS-10 says, you already have 5 crores revaluation reserve. To the extent revaluation reserve is available, adjust this loss against revaluation reserve. Extra loss, so 8 crores la 5 crores we have revaluation reserve, adjust it with that revaluation reserve. Extra loss of 3 crores, that should be taken to P&L. Sir, very simple, sir. Initially, if there is a profit, I will take it to revaluation reserve, sir. Subsequently, if there is a loss, to the extent revaluation reserve balance is available, I will adjust that loss against that revaluation reserve. Any extra loss will be taken to P&L. This is how you have to account for revaluation. Sir, but I have a doubt. What if initially itself there is a loss? Then AS-10 says, initially itself if there is a loss, that loss should be taken to P&L. Sir, first time revalue பண்ணும்போது loss வருது sir. அப்ப that loss will be taken to P&L. Sir, initial loss I took to P&L, sir. Subsequently, second year when I am again revaluing, now I have a profit, sir. That time AS-10 says, last year how much ever loss you took to P&L, this year that much profit you take to P&L, so that you can nullify. Extra profit that you have, that only will go to revaluation reserve. So very, very simple. Okay, sir, I understood, sir. So what AS-10 is telling is, initially if there is a loss, take that loss to P&L. Subsequently, if there is a profit, to the extent of loss that was earlier taken to P&L, this profit also will be taken to P&L. Extra profit will go to revaluation reserve. Revaluation reserve. Okay, that full summary I have given here in the form of a chart. Okay, your ICA itself has summarized this beautifully in the form of a chart. Okay, next point which I want to discuss is, sir, whatever is there in revaluation reserve, what should we do with that? Okay, here AS-10 says you have two methods. This I discussed even in impairment. Remember, we had one important question, impairment revision video also I have discussed. If you have forgotten, please go and see that. Okay. Method 2. AS-10 says, whatever revaluation reserve is there, you can deal with that revaluation reserve in two ways. Revaluation reserve you can deal it with in two ways. One, wait till the end of the asset's useful life, or in other words, wait till the asset is derecognized. Once the asset is derecognized, whatever balance is there in revaluation reserve, transfer it to general reserve. Remember, not P&L nominal, it should be transferred to general reserve. So I will not touch that revaluation reserve till the asset is derecognized. Once the asset is derecognized, then that amount, whatever is there in revaluation reserve, I can transfer it to some general reserves. I cannot transfer it to P&L nominal account. AS-10 is very, very strong in this. Okay. Method 2. Method 2, what AS-10 says is, see, when will revaluation reserve come? Whenever we have revaluation profit. Correct? That means if there is revaluation profit, the value of asset would have gone up. Yes, sir, agreed, sir. If there is revaluation profit, the value of asset would have gone up. Now, because of the value of the asset going up, the depreciation would have increased. Now, what AS-10 says, see, I agree. Because of this revaluation profit, the value of your asset has gone up. once the value of the asset has gone up, there will be extra depreciation. To the extent of that extra depreciation which you are charging because of revaluation, to that extent, every year you can transfer from revaluation reserve to general reserve. Day method 1 la, you will not do anything to revaluation reserve till the asset is derecognized. Once the asset is derecognized only, you will transfer from revaluation reserve to general reserve. But under method 2, every year, to the extent of extra depreciation because of revaluation, you will transfer from general reserve to revaluation reserve. Hope you are very, very clear with this. These are the two methods which you can follow, any one method. Both are allowed as per AS-10. Appo, we learnt about what is cost, how to recognize that cost model, how to recognize that revaluation model, and what to do with the revaluation reserve that is there in the balance sheet. I hope you are very clear. Let us quickly revise depreciation also. In the end, I will come to the two important topics on exchange of assets and replacement of assets. So AS-10 also deals with the depreciation. I hope you all know depreciation refers to decline in the value of an asset. So depreciation, how is it calculated, sir? If you are following the straight line method, it is nothing but cost minus residual value divided by useful life of the asset. Remember, depreciation is an estimate. It is not an actual number. It is an estimate, because the inputs to depreciation are residual value and useful life. Both are estimates. So that is why whatever you calculate using these estimates, which is depreciation, that is also an estimate. And now if there is any revision in useful life, if there is any change in residual value, or if there is any change in the depreciation method you are following, all these are called as change in accounting estimates. All these are called as change in accounting estimates. And for all this, you have to give prospective effect. You should not give retrospective effect. You have to give prospective effect, because all these are changes in accounting estimates. So please remember this. So depreciation is an estimate. So any change in useful life, any change in residual value, any change in depreciation method, all are changes in accounting estimates, which will be given only prospective effect. So now when I should start depreciating an asset, remember this, you should start depreciating an asset once the asset is available for use, or in other words, once the asset is ready for use, not put to use. Here only there is a difference between Income Tax Act and AS-10. Income Tax Act says depreciation should start once the asset is put to use, but here AS-10 says depreciation should start once the asset is ready for use itself. Sir, when should I stop, sir? I know when to start, but when to stop, sir? AS-10 says depreciation will be stopped in either of the three cases. Moon situation la depreciation stop pandra mari varuma. One, obviously everybody knows, when the asset is derecognized, that is when the asset is sold. Asset illa what depreciation. So if that asset is sold, depreciation will stop. Agreed. This is situation 1. Situation 2, AS-10 says, if your residual value is already greater than carrying amount, residual value already greater than carrying amount, then you have to stop depreciation. What is there to depreciate? Already residual value itself is more. You have to stop depreciating the asset till the residual value becomes less than carrying amount. Okay, remember, if the residual value is already more than the carrying amount, then you have to stop depreciation. This is second case. Sir, what is the third case? Third case is, you have to use these words as it is in the exam. Depreciation should stop once the asset is retired from active use. Once the asset is retired from active use and held for disposal. Appadina, inimail you are not going to use this asset. Okay, it has become old. You have taken it out of active usage and you are searching for buyers. You are only holding it for sale. And the mari assets which have been retired from active use and held for disposal, for those assets you have to stop depreciation. So these are the three situations in which you will stop depreciating an asset. Okay, remember this small kutti points irukku. Then we will quickly revise exchange and replacement, konjam interesting points adu rendu. Then we will go to important questions. Okay va. Now whenever you buy a land and building, don't see this as one single asset. Land is a separate asset, building is a separate asset. And remember, freehold land has indefinite life. The life of freehold land is indefinite, or you cannot estimate that. So that is why for land, no depreciation. But for the building part, you have to depreciate, because you cannot say building has indefinite life. Building has only finite life. So for building portion, you have to depreciate. For land portion, you will not depreciate. So remember that. Okay. And ஒரே ஒரு point வந்து, I told you, remember, whenever a PPE is retired from active use and held for disposal, we will stop depreciation. That time what AS-10 says is, the moment you have decided to retire this asset from active use and held for disposal, அன்னைக்கு ஒரு carrying amount இருக்குமா? That you will compare with NRV, whichever is lower, that is the value of that asset which will come in balance sheet. Remember, a PPE which is retired from active use and held for disposal will be valued at carrying amount or NRV, whichever is less. That is the amount at which it will be shown in the balance sheet. This is only applicable for assets which are retired from active use and held for disposal. And finally, AS-10 also says any profit or loss on derecognition. Ipo nee vikkriya, and the vikkamodar profit or loss will come. Sir, how to calculate that profit or loss? Sir, that profit or loss is nothing but you have to compare the sale value and carrying amount. If sale value is more, there is profit on sale. If sale value is less, then there is loss on sale. Both this profit and loss on sale will be taken to P&L. I hope you are very clear with this point. Okay, so let us quickly discuss two interesting topics on exchange of assets and replacement of major parts of the asset. Okay, now whenever you are exchanging assets, that means assume there is A, B. A is giving away land and building. In return, B is giving plant and machinery. Basically, barter system da. Okay, so these two guys are exchanging the assets. Now in this situation, what should we do, sir? When they are exchanging the assets, what should be done? Now AS-10 says, whenever there is an exchange of assets, that time the first point that you should check is whether there is commercial substance or not. Okay, you have to check whether there is commercial substance or not. If there is commercial substance, yes sir, commercial substance is there. Sir, அப்படியே ஒரு நிமிஷம் commercial substance na என்ன கூட சொல்லிட்டீங்கன்னா நல்லா இருக்கும். Day commercial substance means whatever asset you are buying, அதோட cash flows should be different from whatever asset you are giving up. இப்படி வெச்சுக்கோ. By exchanging and getting this new asset, something should commercially or financially change in your business. You should not be as it is. Sir, before exchange also it was like this only, after exchange also it is like this only, then there is no commercial substance. To have commercial substance, whatever asset you have acquired, adoda cash flows should be different from whatever asset you have given up. Adne abuchko. And the mari, if commercially it is different, then there is commercial substance. That time AS-10 says whatever new asset that you are acquiring, for example, A is acquiring this plant and machinery, yeah, that new asset which you are acquiring will be initially recorded at fair value. Sir, edoda fair value, sir? AS-10 says fair value of the asset given up, or fair value of the asset acquired, whichever is clearly evident. எது உனக்கு கிளியரா ரொம்ப ரிலையபிளா மெஷர் பண்ண முடியுமோ use that. Either fair value of the asset given up or fair value of the asset taken over, whichever is more clearly evident, that is the one that should be used for recording this plant and machinery. Sir, what if I know both? I know fair value of the asset given up also, I know fair value of the asset acquired also. In that case, the plant and machinery which A acquired should be accounted at fair value of the asset given up, which is fair value of the land and building. Sir, அப்போ plant and machinery account debit or amount போடணும் இல்ல sir? That is fair value of the land and building. ஆமா, that is the sacrifice that you have made to get the plant and machinery. So remember, if there is commercial substance, the asset acquired should be recorded at fair value of the asset acquired or fair value of the asset given up, whichever is clearly evident. If both are clearly evident, then you have to give priority to fair value of the asset given up. Okay, sir, what if there is no commercial substance? Very, very easy. Okay, if there is no commercial substance, remember this point very, very clearly. If there is no commercial substance, during the exchange of assets in your journal entry, P&L should never come. P&L varave kudadu. Eppo? If there is no commercial substance, P&L should not even come. So then how to pass journal entry, sir? Ipo A gave up land and building. For that land and building there will be a WDV. That WDV only put it for plant and machinery. Sir, basically you are telling pass the journal entry as plant and machinery account debit to land and building. Avladha. Whatever is the carrying amount of the land and building will be debited to plant and machinery. That is all you have to do, nothing else. Able to understand? Please remember, P&L should not even come if there is no commercial substance. I hope you are clear with this. Or rendu question paakalama. Okay, so replacement also I will teach you through a question. A very interesting question is there in your book bag, so we will solve that question so that it will be more easier for you. 1 minute. First question itself, it is on exchange. Just a minute. First question says, entity A exchanges land with a book value of 10 lakhs for cash of rupees 20 lakhs and the plant and machinery valued at 25 lakhs. Okay, see, what they are doing is entity A exchanges land with a book value of 10 lakhs. So in A's books there was a land whose book value was 10 lakhs. Okay, this they are giving up for, now in this land A is giving up for that, in return what and all they are receiving is, they are receiving cash of 20 lakhs and they are also receiving a plant and machinery. Basically they are giving land and they are receiving cash and plant and machinery. Okay, so what is the value of cash you are receiving? 20 lakhs and plant and machinery valued at 25 lakhs. What will be the measurement cost of the assets received? Consider that the transaction has commercial substance. Let us see the journal entry. Gavani, ipo land and building is going out, that is why we are crediting land. Sir, at what value we should credit, sir? What is the book value? 10 lakhs. How much cash is coming inside? 20 lakhs. So cash account debit 20 lakhs. Plant and machinery is also coming inside. Yes sir, plant and machinery also is coming inside. So plant and machinery also should be debited. Sir, but what is the value of the plant and machinery? This transaction has commercial substance. What AS-10 says, fair value of the asset given up or fair value of the asset acquired, whichever is clearly evident. Here, which is the asset given up? Land. Which is the asset taken over? Plant and machinery. Sir, but in this question we don't have land's fair value. Yes. So in this question land or a fair value illa. Upper fair value of the asset given up is not there. Then which one we will take? Fair value of the asset acquired. Which is the fair value of the asset acquired? Machinery. Other fair value is 25 lakhs. So you will debit at 25 lakhs. Basically, whatever land was there, other book value was 10 lakhs. You gave up that. You got cash of 20 plus plant and machinery of 25. So totally you got assets worth 45 for a land having book value of only 10 lakhs. Upon remaining 35 lakhs is your profit, which should be taken to P&L, which should be taken to P&L. Clear, 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 able to understand this? Okay, so this is how you have to pass when there is commercial substance. Okay, va? Next, entity A exchanges car X with a book value of 13 lakhs and a fair value of 13 lakh 25 for cash of rupees 15,000 and car Y which has a fair value of 13 lakh 10,000. The transaction lacks commercial substance as the company's cash flows are not expected to change as a result of exchange. Here no commercial substance. That means remember in the journal entry P&L should never come. Okay, it is in the same position as it was before the transaction. What will be the measurement of the assets received? Let us do this. So car X is going outside to car X. Okay, what is the book value of car X? 13 lakhs. What is coming inside? Cash is coming. How much cash is coming? 15,000. So cash account debit 15,000. Now what is also coming inside? Car Y. Sir, what should be the value of car Y, sir? Sir, car Y or fair value pottalama, sir? No. There is no commercial substance. That means P&L should not even come in this journal entry. So then what will be the value of car Y? Very simple, listen. The balancing figure, 13 lakhs minus 15,000, 12 lakh 85,000 will be the value of car Y. So, sir, appo purinjad sir. Car X create panni thookitom 13 lakhs. Cash 15,000 we have recognized. And you told if there is no commercial substance, P&L should not come. Then the remaining balancing figure will be for car Y, which is 12 lakh 85,000. I hope you are very, very clear with this. So ensure you just once go through these two questions. Okay. Next I want to discuss one more question on replacement of parts. Bharat Infrastructure Limited acquired a heavy machinery at a cost of 1,000 lakhs. The breakdown of its components is not provided. The estimated useful life of the machinery is 10 years. At the end of year 6, the turbine, which is a major component of the machinery, needed replacement as further usage and maintenance was uneconomical. They were not able to maintain that. The remainder of the machine is in good condition and is expected to last for the remaining 4 years. The cost of the new turbine is 450 lakhs. Give the accounting treatment for the new turbine assuming SLM depreciation and a discount rate of 8%. Let me quickly tell you the concept behind this. See, AS-10 says whenever you are replacing any major part or major part of an asset replace பண்ணும்போது whatever part that you are throwing out, that will have one WDV. That WDV should be reduced from the value of the big asset. Ipo assume in this phone, this is my PPE assume. In this phone assume I am changing the glass or screen. Now the screen will have one WDV which is included inside this phone or the WDV. That screen, when I am replacing that, whatever is the WDV of the old screen, I will subtract from the WDV of this phone. And whatever is the cost of the new phone, whatever is the cost of the new screen, that new screen cost will be added to the WDV of this phone. I hope you are clear with this. So whenever you are replacing any major part, the old part WDV, after charging depreciation for that old part, whatever WDV is included in the cost of the total asset, that should be removed by subtracting, and whatever is the cost of the new part, that should be added. Now here only one interesting point. Sir, but when I initially purchased this phone, I don't know what is the cost of the screen, sir. That vendor also didn't tell me, sir. Then what to do? That time AS-10 says, Assume I purchased this phone 4 years back. That time only the old screen also I would have purchased. Now I don't know what is the WDV of the old screen, because I don't know what was the cost of the old screen at the time of purchase 4 years back. Then what AS-10 says, you have to estimate what is the cost of the old screen. I am asking AS-10, how to estimate AS-10? Wait, I will tell you. Now we are purchasing a new screen. That new screen will have a cost. Assume that new screen which I am purchasing now has a cost of 2000. What you do? You discount this 2000 rupees for 4 years. Sir, why 4 years? Because 4 years back only I purchased the old screen. Whatever present value you get, take that as the cost of old screen. Now you have a cost for the new screen. Discount that, go back, whatever present value you get 4 years back, that will be the cost of the old screen. That you depreciate again for 4 years. Then you will get book value of the old screen. That book value of old screen I will subtract from the WDV of this phone, and whatever is the new screen, that new screen cost will get added to the phone. This is how you have to remember this replacement of assets. That is what is actually tested in this question. Let's see how to solve. Okay, so I purchased a big machinery for 1000 lakhs. Okay, wow. And useful life is 10 years, and the question says SLM depreciation. So 1000 by 10, 100 lakhs is the depreciation. Now like this I was depreciating for 6 years, everything was good. So that means 6 years if I depreciate, I would have depreciated 600 lakhs. So the carrying amount of this heavy machinery will be 1000 lakhs minus 600 lakhs, 400 lakhs will be the WDV, correct? Now what happened at the end of year 6, in this machinery there was one major part called turbine. That turbine I had to replace. So inside this 400 lakhs and the old turbine or the WDV irukuma, old turbines WDV will be there, that I should subtract. But the problem is, initially when I purchased 6 years back, I don't know what is the cost of the turbine. Then AS-10 says, now we are purchasing a new turbine. Yes, you know the cost of that. Yes, what is the cost of that new turbine? 450 lakhs. This 450 lakhs, you discount it using a discount rate of 8%. 6 years back, basically 450 lakhs divided by 1.08 power 6. That if you do, you will get a present value. You will get a present value of 283.58 lakhs. This will be the original cost. This will be, remember, this will not be WDV. This will be original cost of the old turbine. That again you depreciate for 6 years. Sir, how to do that? 283.58 divided by 10. 28.358 will be the depreciation per annum. So into 6 if you do, you will get the depreciation for 6 years. Depreciation for 6 years, which is, let me just calculate once. 28.358 into 6, it will be 170.15. So 283.58 minus 170.15, which will be 113.43. That will be, that 113.43 will be the WDV of the old turbine. So whatever 400 we have, from that subtract the WDV of the old turbine and add the cost of the new turbine. Clear? This will be the revised carrying amount of that machinery, which will be depreciated further. I hope you are very, very clear with this. So please ensure you practice this once. It's a very, very interesting question. Next interesting question which I want to discuss is,
this one also very interesting question. See, actually, this question was asked as a part of MCQs in one test paper. This question was actually inspired from a CA final question. So don't think, sir, this is CA final question. No, again, as I'm telling, this was tested in one of the test papers in CA Inter also, because AS-10 and AS-16 are almost similar. So those questions there can also be tested at inter level. On 1st April 20x1, Sun Limited purchased some land for 10 million. 10 million means 1 million is 10 lakhs. So 10 into 10, 100 lakhs they have purchased. Okay, including a legal cost of 10 lakhs. So in the 100 lakhs kuliye, there is a legal cost of 10 lakhs also. Whatever legal costs that you incur at the time of acquisition can be capitalized in order to construct a new factory. Construction work commenced on 1st May 20x1. Any construction work commenced such 1st May. This date is important. Remember, later I'll tell you. Sun Limited incurred the following cost in relation to its construction. Preparation and leveling of land. Yes, this can be capitalized because this is necessary for construction. Purchase of materials for construction. Yes, this also can be capitalized. 6 million. Employee cost of the construction workers. It is 2 lakhs per month. So below he will give how many months of construction was there. We have to multiply. Overhead cost incurred directly for the construction of factory. It is directly for the construction of factory. So that also can be capitalized. Ongoing overhead cost allocated to the construction project using the company's normal overhead allocation model. Remember, this should not be taken. This should not be taken. Sir, why, sir? Because it is only an allocated overhead. This is not an overhead which is directly attributable to the acquisition of PPE. Only those overheads which are directly attributable to the acquisition of PPE should be capitalized. These general overheads which are allocated should not be capitalized. Income received during the temporary usage of factory premises as a car parking. This also is not related to construction. This should also be taken to P&L. Cost of relocation of employees. This is also not related to construction. This also should be taken to P&L. Cost of opening ceremony. As I already told you, inauguration cost also cannot be capitalized. So this also should be taken to P&L. Okay, so this cost will be capitalized, this material cost will be capitalized, labor cost will be capitalized, and this directly attributable overheads will also be capitalized. This ongoing overheads will be taken to P&L. Temporary income by using it as a car parking will also be taken to P&L. Cost of relocating the employees also will be taken to P&L, and cost of the opening ceremony, which is inauguration ceremony, that also will be taken to P&L. Let's see what else is given in this question. The factory was completed on 30th November. Remember guys, when was it started? May, June, July, August, September, October, November. So 7 months was the effective construction period, okay, which is considered as substantial period as per AS-16. So what they are telling is, sir, generally AS-16 la substantial period, not 12 months or more. No, sir. There itself they would have given even a period less than that can be considered as substantial period, provided a justification is given. So here, even though it is 7 months, since the question itself says take it as substantial period, you can take it as substantial period. And that means, sir, whatever is the interest, that should be capitalized, sir. Ama. Okay. And in the machinery which they started production on 1st February. So if you see the timeline of events, actually what happened is, in April they purchased land. In May they started construction. In November they completed construction. And then actual usage they started doing from February. Okay, November itself the asset was ready for use. After this, no capitalization. You should charging depreciation also. Okay, remember this. Next, the overall useful life of the factory building was estimated as 40 years from the date of completion. Eppa completion? 30th November. However, it is estimated that the roof will need to be replaced 20 years after the date of completion. Appo total building ku 40 years is the useful life, but roof, which is a major component, adukku only 20 years. So here you have to follow component method of depreciation. Whatever is the amount attributable to roof, that will be depreciated within 20 years. Whatever is the amount that is attributable to building, the remaining building will be depreciated for 40 years. Okay, and the cost of replacing the roof at current prices will be 30% of the cost of the total building. Appo whatever is the building cost is there na, in that 30% will go to roof, remaining 70% will go to the remaining part of the building other than roof. At the end of the 40-year period, Sun Limited has a legally enforceable obligation to demolish the factory and restore the site to its original condition. Restoration obligation, decommissioning and restoration. The directors estimate that the cost of demolition in 40 years time, based on prices prevailing at that time, will be 20 million. Guys, remember, this is future value. An annual risk adjusted discount rate which is appropriate to this project is 8%. So this has to be present value da. For that they are using 8%. The present value factor of 1 rupee payable in 40 years time at an annual discount rate of 8% is 0.046. Present value factor also they gave it to you. So 20 into 0.46. Daivame, if the question itself gives present value factor, don't do any overaction, please. Use the same present value factor. So 20 into 0.046, which will be 0.92 million. This will be the present value which will be added to the cost of the building. The construction of the factory was partly financed by a loan of 17.5 million taken out on 1st April 20X1. The loan was at an annual interest rate of 6%. Sun Limited received investment income of 1 lakh on the temporary investment of the proceeds. Compute the carrying amount of the factory on the balance sheet of Sun Limited at 31st March 20X2. Explain the accounting treatment of all the amounts referred to in this part of the answer. Ready? Let us see what all cost you will take. First you will take land cost, which is 10 million. Sir, adana sir 10 million 10,000 potrukanga, they have written in thousands. Okay, remember 1 million is thousands. So 10 million is 10,000 thousands. So that they will take. Then whatever is the leveling cost, I told you, right, less leveling cost also should be taken, which is 300,000. So that will be taken at 300. Then whatever is the material cost, 6.08 million, that also will be taken. 6.08 na 6080 thousands, that 6080 thousands also will be taken. So preparation leveling edthirukanga, materials they have taken. Sir, what about next one? Employee cost 2 lakhs per month, and 7 months was the construction period, because from May to November. So 2 lakhs into 7, 14 lakhs, which is 1400,000. So that 1400,000 also will be added. And the directly attributable overheads 1 lakh, 7 months. So 1 lakh into 7 lakhs, which is 700,000. That also will be added. Allocated general overheads will not be considered, as we discussed. Temporary income from car parking will not be considered. Relocation cost also will not be considered, and inauguration ceremony cost also will not be considered for capitalization. Able to understand? Now wait, remember. Now if you see how much is the amount that you have taken, sir, for capitalizing. $10,000 plus 300 plus 6080 plus 1400 plus 700, which is 18,480. Yeah. This is the total amount of cost we have incurred. Now, in this total 18,480, 17.5 million, okay, which is 17,500 thousands. Out of this 18,480 cost, 17,500 came from a loan, and this loan is used for a qualifying asset. So whatever, listen, so whatever interest that you are paying on this loan, since it relates to a qualifying asset, it needs to be capitalized. It needs to be capitalized. Able to understand? Okay, so this 17,500 la whatever is the interest, sir, how much interest, sir? 6%, that needs to be capitalized. So how to calculate this capitalization? Remember here there's one interesting point. 17,500 into 6%. Sir, how many months I should take, sir? Remember guys, capitalization will commence not when the land was purchased, but when the construction actually started. You cannot start capitalizing just by buying a land. Sir, I purchased land and kept. Can I start capitalization? No. Go to AS-16 and see commencement of capitalization condition. It clearly says activities which are necessary for construction should have been started, and those activities which are necessary for construction started only in May, and the total construction got over in November. So we can capitalize only for 7 months, not for 8 months. So 17,500 into 6% into 7 by 12, which is 612.5 thousands. This is the finance cost which will be capitalized. This is what they have calculated here. Sir, all over, sir, illada, wait. Now this, for this specific borrowing, they have temporarily invested and they got 1 lakh income. So temporary investment, any interest income on temporary investment or specific borrowings should be subtracted from the borrowing cost which is capitalized. So 612.5 add pannu. This 1 lakh income which is 100,000, that should be subtracted, and then whatever is the demolition cost provision which we calculated, remember our 20 million to 0.046, 0.92 million, which is nothing but 920,000. This amount should be added to the cost of the asset. Finally, this is the final cost of the asset. So 19,912.5 thousands is the cost of the asset. Now they also want us to calculate depreciation. Here we have to be careful. 30% is for the roof. Remaining 70% will go for other parts. So, and remember guys, very important point which many of you will miss. Wait. 19,912.5. Remember here, many of them will make a mistake. In this 10,000 is for land, guys. For land there is no depreciation. So please don't depreciate that. Okay. Remaining 9,912.5, in this 30% will go for roof. Remaining 70% will go for other parts of the building. Clear? Please. So land 19,912 kulla 10,000 land is there. That should not be depreciated. So remaining 9,912 only split it as roof and other parts. So 9,912.5 into 30%, 2973.75 is the cost of the roof, which should be depreciated over a period of 20 years. Sir, from when depreciation can start? The asset was ready for use from November end itself. That means December, Jan, Feb, March. So 4 months you can depreciate. Into 4 by 12, you will get depreciation on the roof. Sir, what about the remaining 70%? And the 9,912 into 70%, this amount which is 6,938.75 divided by 40 per year depreciation into 4 by 12 will give you depreciation for the remaining parts. This depreciation, if you subtract from 19,912, you will get the carrying amount that should be shown in the balance sheet. I hope very clear. This is a very super question. It covers many topics. It clarifies cost concept. It clarifies certain interesting principles in AS-16. It also clarifies our component method of depreciation. So please ensure you definitely practice this question. Okay, wow. 2 more questions I want to discuss. Then we'll close this AS-10. This is your book back question, a very interesting one. And there's one more interesting question on deferred credit, a concept called deferred credit, that also I want to discuss. Akshar Limited installed a new plant, which is not a qualifying asset. at its production facility and incur the following cost. Okay. Cost of the plant 30 lakhs. Delivery and handling cost will be capitalized. So 30 plus 1, 31. Site preparation cost will be capitalized. 31 plus 2, 33. Consultant fees for advice on acquisition of plant. This is a professional fees related to acquisition of plant. This should also be capitalized. Plus 50,000. 33.5 lakhs. Interest charges paid to suppliers against a deferred credit. Sir, what is this, sir? Now I have to pay money to the supplier. That supplier is telling, you take time, I will give you extra time. But I am giving you extra time, for that you give me interest. That interest is 1 lakh. Sir, now whether this interest can be capitalized? No, this is not a qualifying asset. So this interest should not be capitalized. This interest should go to P&L. Remember, estimate of dismantling and site restoration cost is 50,000 after 10 years. Present value is 30,000. Remember, present value add panama, future value present value. So plus 30,000.3 lakhs, which will give you 33.8 lakhs. 33.8 lakhs. So 33.5 plus 0.3 will give you 33.8 lakhs. Operating losses before commercial production, these are operating losses that should go to P&L. It should not be capitalized. So total cost is 33.8 lakhs. Next, let us see what that is. The company identified motors installed in the plant as a separate component and a cost of 5 lakhs. Purchase price 5 lakhs. And other costs were allocated to them proportionately. இப்போ என்ன சார் சொல்ல வராங்க கவனி. See, in this 33.8 lakhs, 30 lakhs is the actual purchase price. 3.8 lakhs are other costs which we are capitalizing. Correct? Now, what you should do is, in the 30 lakhs purchase price, 5 lakhs is towards motor. 25 lakhs is towards other parts. Now the question says, so purchase price of pistoma, motor ko, other parts ko, adhe mari 3.8 lakhs other parts oda cost irukilla. In that also you have to split between motor and other parts. Sir, how much I should allocate to motor? The question says, allocate in this ratio, 5:25. 1:5. அப்ப 3.8 ல 1.6 sorry 1/6 3.8 ல 1.6 which is 0.633 will go to motor. Remaining amount which is 3.167 lakhs will go to other parts. அப்ப finally if you see, motor cost will be 5 lakhs plus 63,333, which is 5,63,333. Other parts will be 25 lakhs plus 3,16,667, which is 28,16,667. This will be the cost of the remaining parts. Now, sir, why are we splitting like this? Because motor has different useful life, other parts have different useful life as per the question. The company estimates the useful life of the plant and those of motors are 10 years and 6 years. Motor life and 6 years, other parts life is 10 years. So you have to depreciate them accordingly. And SLM method of depreciation is used. At the end of year 4, the company replaces the motor installed in the plant at a cost of 6 lakhs. And the estimated useful life of the new motor is 5 years. So there is replacement of parts. Also the company revalued its entire class of fixed assets at the end of year 4. The revalued amount of the plant as a whole was 25 lakhs. At the end of year 8, the company decides to retire the plant from active use and also dispose the plant at a value of 6 lakhs. There is no change in the dismantling and site restoration liability during the period of use. You are required to explain how the above transaction should be accounted in accordance with AS-10. Let's solve this very interesting question. Book back question da. Motor ka how much cost we gave? 5,63,333. Either life was 6 years. So per year depreciation will be So per year depreciation will be 93,888. 4 years depreciation potroma into 4 pota will get 4 years depreciation, that you subtract from 5,63,333, you will get book value. So 5,63,333. From this, if I subtract 6 years depreciation, I will get 1,87,778. This will be the book value of this motor at the end of year 4. Other parts, which is how much? 28,16,667. Either life is 10 years, so every year depreciation will be 2,81,667. Like that we have to charge for 4 years. That 4 years accumulated depreciation you can subtract from the cost. So 28,16,667 minus that 4 years depreciation will give you 16,90,000 is the cost of the, is the WDV of the other parts at the end of year 4. Now what we are doing? We are replacing this old motor. So this old motor, the WDV, whatever is there, this we will charge it to P&L. Whatever is the new motor which we purchased for 6 lakhs, that will be added to the cost of the asset. So 16 lakhs 90 plus 6 lakhs, 22 lakh 90 will be the cost of that revised carrying amount of this machinery. Able to understand, whatever is the WDV of the old part will be derecognized and charged to P&L, and whatever is the cost of the new part will be added to the carrying amount. So, if carrying amount 22 lakh 90,000, correct? Now what they are doing? They are revaluing this. In the 22 lakh 90, they are revaluing 25 lakhs they are revaluing. Sir, how much is the revaluation surplus or revaluation profit, sir? 25 lakhs minus 22 lakh 90, 2 lakh 10,000 will be the 2 lakh 10,000 will be the revaluation profit. Sir, but you know, a doubt. This revaluation profit 2 lakh 10,000, is it coming from other parts or is it coming from motor, sir? Obviously think நம்ம இந்த புது மோட்டார் வாங்கினதே இன்னைக்கு தான். அப்போ this 6 lakhs itself is market value today. அப்போ how will you get revaluation profit for that? That motor was purchased today only. So that motor's market value will be 6 lakhs only. So there will not be any revaluation surplus for that motor. Whatever 2 lakh 10 is coming as revaluation surplus, that is the full revaluation surplus for other parts. அப்போ என்ன ஆகும்னா other partsக்கு 16 lakh 90,000 plus 2 lakh 10,000 revaluation surplus, this will be at 19 lakhs and motor will be at 6 lakhs. Using this only we have to depreciate further. Clear? Sir, இப்போ எப்படி sir depreciate பண்ணணும்? This 19 lakhs will be depreciated for remaining 6 years. 4 years the over, and the 6 lakhs will be 6 lakhs new motor will be depreciated for 5 years. Sir, where is it given, sir? It is given in the question, sir. Okay. Then what happened? Like this they used for another 4 years. At the end of year 8, they are selling it. So first shall we calculate the carrying amount at the end of year 8? 19 lakhs remaining 6 years useful life divided by 6, we will get 3,16,667. Like this we will charge for 4 years. So after subtracting that 4 years depreciation, shall we see what is the revised carrying amount? It will be 6,33,333. Okay. And in the 6 lakhs new motor also we should depreciate for 4 years. The useful life is 5 years. So 6 lakh by 5, 1.2 lakhs will be depreciation per annum. For 4 years we will charge 4.8 lakhs. So 6 lakhs minus 4.8 lakhs, 1.2 lakhs will be the WDV of that motor. So total WDV will be 7,53,333, which was sold for 6 lakhs, So total loss the 7,53,333 is the WDV, which was sold for 6 lakhs. So remaining 1,53,333 is loss on sale, which should be taken to P&L, Clear? Able to understand? Okay, நம்ம டைரக்டா போட்டுருக்கோம், நம்ம தனித்தனியா போட்டுருக்கோம். So even then you'll get the same answer. So this 24,425 plus 128,907, which is same as that 1,53,333. Is this very clear? If you want, you can also do like this separately. Sir, how to do separately like this, sir? What they have done is, whatever 6 lakh sale value that they received from sale of machinery, that they divided between motor and other parts in the ratio of their carrying amount. Sale value a ratio of carrying amount la pirichu, then they are comparing with the carrying amount and finding out separately profit or loss for both motor as well as other parts. Even if you do like that also, you'll get the same answer. If you do it together also, you'll get the same answer. Sir, now what we should do in the exam, sir? What you do is, if the same question comes, you do it separately, because ICA will consider that as one step mark. So whatever 6 lakhs you get, split that 6 lakhs in this 1,20,000 is to 6,33,333 ratio. Then you will get sale proceeds for motor. Compare that with carrying amount of motor. You will get profit or loss. Same way, whatever sale value that is attributed to other parts, compare that with carrying amount of other parts. Remaining will be profit or loss. Okay, this is how you have to solve this sum. I hope you are very clear. Ensure you practice this sum also. Now one more question I want to deal. Guys, there are all the important questions I have given in this practice question, so ensure that you practice these ones definitely before the exam. On 1st April 20X1, an item of property is offered for a sale of 10 million, with the payment terms being 3 equal installments of 33,33,333 over a 2-year period. Payments are made on 1st April 20X1, 31st March 20X2, 31st March 20X3. அப்படினா you are purchasing a property which is worth 10 mil. Okay, this you are not going to pay it fully upfront. You are going to pay in 3 installments of 33,33,333. So 10 million means 100 lakhs. So one installment of 33,33,333 you will pay immediately. The remaining 2 installments you will pay after 1 year, at the end of 1 year, and the third installment will be paid at the end of 2nd year. Now like this, when you are given too much credit period, 2 years time you are given, okay, you think of it, the guy who is selling you, why will he give you 2 years time? If he is like that giving you 2 years time, he has to recover interest from you also. So what AS-10 says is, whenever like this extra credit or deferred credit is given, whatever price the supplier charges is including interest. So from that we have to remove interest. Remaining amount only is the value of PPE. Sorry, eppadi sir ipo paru 10 million the 10 million how will we pay? Immediately we will pay 33,33,333. At the end of year 1 we will pay another 33,33,333. At the end of year 2 we will pay another 33,33,333. Now AS-10 says like this, if you are given 2 years period, that means you are not only trying to recover the cost of the plant, you are also trying to recover interest. That interest should be separately recorded and taken to P&L. You cannot capitalize as a part of the plant. Sir, how will I know how much interest is there in this, sir? Adukda our sir has given discount rate. Using this discount rate, present value all this future cash flows, you will get one present value. That present value is only the cost of the plant and machinery. See, I will show you the calculation that they would have done. Pare 3 installment, 1 you are paying immediately, so for that always present value factor will be 1 because no need to discount. This is the present value. This you are paying after 1 year. Sir, how did they get this 0.949, sir? 1 divided by 1.0536 for 1 year. This is the present value. This they are going to pay after 2 years, so it will be 1 divided by 1.0536 square. This will be the present value at the end of 2nd year. In the 3 add panna, you will get total present value. So what AS-10 is trying to tell is, though you are recovering 100 lakhs from me, In that 95 lakhs is actually the cost of the PPE. Remaining 5 lakhs you are recovering from me as interest. So that cannot be added to PPE because it's not a qualifying asset. Only if it's a qualifying asset you can add. So AS-10 says, first you record this 95 lakhs separately by passing the journal entry, PPE account debit to payable. Liability irka pay pannuma? 95 lakhs, 95 lakhs. In this immediately you are paying 33 lakhs. Payable account debit to bank account. 33 lakhs, 33,333. In the end entry you combine panida, IC has passed the first entry directly. Okay. Now how much balance we will have in payable account? 95 lakhs minus 33 lakh 33,333, which is 61 lakh 66,667. Now this is present value. So slower we should keep adding interest and making payment. Finance lease panna adhe mari da. So idukku evlo sir interest? 1 year interest will be 0.0536, which is 61 lakh 66,667 into 0.0536, 3,30,533. In the interest, what will be the journal entry, sir? Interest expense account debit to payable. Okay, 3,30,533. Okay, wow. Now what will be the carrying amount after adding this interest? 61, 66, 667 plus 330, 533, which is 64 lakh 97,200. Okay. Now we have to make the first installment at the end of 1 year. Adikena sir journal entry again payable to bank. Okay, once you pay this, the remaining balance will be 31 lakh 63,867. Now we have come to second year. Again we have to put another interest on this into 0.0536. Which is 1,69,583. Sir, again what is the journal entry for this? Interest account debit to payable. It will get added to the payable because along with principal you have to pay this interest also. So totally you will get 33 lakhs 33,000, some 450 you will get. There will be some small rounding of difference. So based on that rounding of difference, adjust this interest. So finally your payable will have a balance after adding this interest of 33 lakh 33,333, and finally second installment also will be paid payable to bank. So bank will, this payable account will get closed. That PPE which you capitalized at 95 lakhs will get depreciated based on its useful life. So you're able to understand like this. When you are given extra credit, when the supplier is giving you extra credit, that means he is trying to recover the interest portion also. So he is not only recovering the cost of the PPE, he is recovering the interest portion also. So AS-10 says find out how much is that interest portion, keep that separate, remaining only will be capitalized. So how to calculate the interest portion, sir? Do the present valuation of whatever future cash flow that you are going to pay. That present value only should be capitalized. Remaining amount should be recorded as interest. If that interest is used for a qualifying asset, then capitalize. Otherwise, that interest should be taken to P&L. Hope you are very, very clear with this. Guys, this is a big standard, but actually conceptually it is easy. So ensure you understand cost very well. Ensure you understand revaluation model very well. Ensure you understand exchange, replacement of assets, decommissioning very well, and please just practice all these interesting questions, especially that Sun Limited, the before question that we did on the 10 million land vaangnangala. That question is very, very interesting. It covers multiple concepts. In the motor question also is good. This deferred credit question also good. All the questions that we have discussed in this revision are actually excellent questions. So please ensure you are able to solve this. Idhe nee solve pandra meedi ella question you will be able to solve. So please quickly revise through the notes and ensure you do all the important questions. Definitely you will be able to answer this. Clear, everybody? So AS-26 also will be uploaded to AS-26 also will be uploaded as a part 2 of this. Meanwhile, watch AS-10. AS-26 video also will follow. Thank you so much.